transfer pricing. So I'm assuming you knowledge threshold is really gone up with the help of CTC, and I consider it my privilege to be here again as a speaker. And every time I'm given an opportunity to speak before all of you all, it also gives me an opportunity to learn a new subject. And this is one more subject that I have not had the experience of handling in the past. But because of this opportunity, I've kind of tried to cover some aspect of this subject, which in a sense is relevant. It could be explosive in nature, if you may say that. There is clearly no convergence happening in terms of what happens in transfer pricing as opposed to customs. But of course, let's go through the basis of the subject and understand what it entails for us as practitioners, and also on the other side as taxpayers, what is that this subject really unfolds for us. If I may just put it that this subject has, I would say, it's a global tax implication. It is not confined only to India. Some of the tax controversy that we have seen in India in the last few years are arising out of the interpretation of the transfer pricing regulations and the rules by the tax authority, which is more India specific, I put it. For example, the valuation of shares, the controversy surrounding that is more India specific as opposed to what you may find elsewhere in the world. In comparison to that, this particular issue of transfer pricing versus customs regulations is more or less a global phenomenon. So it's not that India is isolated in this direction. But I would also like to add over here is that globally, the world is struggling with this issue. There is no set rules over here. OECD has not got any framework of rules to prescribe for handling situations like this. So that's some of the facets of this particular situation. Again, there is not much jurisprudence on the subject, except that on both the sides of the regulations, whether it is transfer pricing or custom regulations, we find decisions which overlap into each other's domain, but it is not that some kind of convergence is happening in terms of what could be a takeaway for a transfer pricing specialist for that purpose. If you see in the last couple of years, there is a marked shift from the tangible goods to intangibles. So whereas tangibles had the initiation of starting in terms of what controversy we saw in the last, I would say probably in the first 5 or 6 years. Gradually we see the shift happening more towards intangibles. The BPS project that OECD started last year has probably shifted the focus completely towards the digital economy and the tax evasion that is noticed because of that. So that's some of the trends that internationally you could notice in light of what this particular subject is. So let's look at it and go into the issue specific to understand what is therein for us. I may just add one more aspect to this, is that why is it that there are more case laws in transfer pricing as opposed to customs. So if you see the customs regulations and the jurisprudence on this subject, you may not find as many overlaps in terms of transfer pricing related issues. They're more confined to, how would I say, more to do with royalty, whether includable in the valuation of goods or not. That's probably the largest set of controversies in customs. And I think it rightly so, because customs being a transactional tax, unless you import the goods in India, and unless the goods have come in, and there will be the transfer pricing, which is more an annual exercise at a later point of time. So customs controversies precede transfer pricing in a sense, and therefore you will find more case laws in transfer pricing on custom related issues as opposed to the other way around. So that's the nuance that we need to understand, is that transfer pricing is more, how would I say, some kind of a follow-up on year that's already gotten over. So except for the planning opportunities or price setting that you may want to consider beforehand, customs will always precede transfer pricing in terms of the controversy. They don't go hand in hand, in other words. So let's look at what are the major facets of transfer pricing in customs. The critical part of transfer pricing, as we all understand, is that it seeks to prevent shifting of profit by MNCs from high tax jurisdictions to low tax rate jurisdictions, essentially to minimize tax cost. As opposed to that, customs valuation, which is a process where customs authorities assign a monetary value to goods for the purpose of import. So that's the difference in both these subjects in terms of what does transfer pricing regulations try to achieve, is that they are looking at how do you address a situation when there are imports coming from a multinational group company from which is an A. As opposed to that, customer is purely looking at a valuation exercise to determine the value of goods that's been imported into India. Transfer pricing, as we know, is part of the Income Tax Act, and as comparison, customs is part of the 1962 Customs Act, the provisions therefore. Transfer pricing again takes care of the concept of arm's length as a price determination for all intercompany transactions. Whereas in terms of customs, the focus is more on the import from related parties. That's what is again arm's length price determination is there, fair market value. Lastly, as we know, that the transfer pricing regulations in India are based on the OECD guidelines broadly, as opposed to that customs are based on the WTO agreements on customs valuation. So these are some of the key differences which you notice on both sides of the regulations, transfer pricing on one side and customs on the other hand. So let's look at and dive into the controversy per se. So if you deep dive into a situation where there's an import that happens from any, you would notice that there is an import that happened in a particular situation from, let's take an example of estimated being a foreign related party. In terms of our understanding, it is called associated enterprise. When the import happens, the argument which, and of course the import price is taken at 100 rupees. The custom authorities would want to value this at 120 rupees, being with the contention that you have under-invoiced the import from a related party. Whereas the transfer pricing authorities would want to put it that you should not have paid 100 rupees, you should have paid only 80 rupees for this particular product. So if you look at it, as the price goes up, the custom duty impact will be higher, but at the same time TP risk would be higher. As opposed to that, when the price is lower, the TP risk would get minimized to that extent, but the custom duty risk will increase proportionately. So these are some of the, if you see the absolutely diametrically opposite takeaways on the side, is that what transfer pricing is trying to do is to push the prices down, as opposed to that customers want to push the prices up to garner more revenue. So there's an inherent contradiction between two regulations that come across as transfer pricing practitioners, and it's how do you find a balance in this situation? That's a key issue. That's a challenge for the taxpayer. How do you find the optimum balance between transfer pricing regulations and customs for that? So with this background of the key, how would I say, the contradiction that is set inherent in the regulation, let's go further up and see what is it that really unfolds for us. If you see, the key concern is that the price paid to the related party for a purchase transaction is too high, is the contention of the transfer pricing officer. As opposed to that, the custom authorities may come around saying that the price that you're paying for the same purchase transaction is actually too low. So there are two regulators saying two different things over here. Of course, the primary objective is to maximize taxable income in transfer pricing case, which means more taxes, of course, but at the same time, that can be achieved only if you minimize the value of the goods. So the transfer pricing officer's contention would always be geared to say that you should minimize the cost of imports so that there will be more taxable income in India. But as opposed to that, the custom authorities would want to garner more customs duty, for which they would want a higher price to be paid for imports. So that would be their contention on the other side. So that is the primary objective for that. So there's one is to minimize value of goods, and the other side there's a maximization of value of goods for the purpose of import. So that's the contradiction which you may discover in transfer pricing versus customs. Of course, we know that transfer pricing is a very large landscape of transactions to look at. So we have import and export of services, tangibles, intangibles. Of course, the largest amount of controversy currently is a spate of issues that we see on the intangibles, not only in India as well as internationally. The focus is clearly shifting to intangibles as there's a larger domain of controversies. And the transaction coverage is also very large. As opposed to that, insofar as customs are concerned, it is restricted to the import of tangibles from related parties. So it's a small spectrum of transactions that we look at in customs. Again, we have seen, if you look at what is associated enterprises and related party tests. So the definition, of course, is there in section 92F, which has certain direct enterprises which should be covered, as well as certain deeming provisions in terms of what else could be called as associate enterprises, which is a large, again, basket of number of case entities that could get covered with this particular definition. For customs, again, there are broadly very three clear categories. Is that one of them directly or indirectly controls the other as the first concept. The second is both of them are directly or indirectly controlled by third persons. That's another possibility that could be there in customs. And lastly, together they directly or indirectly control a third party. So if these three relationships exist insofar as customs is concerned, then the transactions of imports are covered under this custom regulation insofar as the valuation rules would be applicable. So that's how would I say, if you look at in the transaction as well as the definition of AE, transfer pricing coverage is much larger as opposed to customs. So that's some of the differences that you notice as we go forward.
So in custom, the 26% statutory is there or any other limit is there?
Sorry?
For control, any percentage is there like in custom?
No, there is no percentage. There is only a broad definition which is in these three parts, is that if it is controlling one part, entity controls the other is one definition, second is both of them are controlled by a third party, or both of them together control a third party. So that's a definition. So we do not have that kind of ingrained definition as we find in transfer pricing in custom regulations. So let's look at the valuation objective in terms of transfer pricing. Is that the test of transfer pricing is, of course, as we all know, is that purchase of goods and services need to meet with the ambient price. That's the fulcrum of how we practice transfer pricing as per the OECD guidelines. Whereas under the customs regulations, what is determined is whether the relationship between the parties, when there are related parties, has affected the price. That's a small nuance over there, is that all that we need to justify over here is that whether the relationship has affected the price. That's a definition take away from here, from the definition that we have brought in over here in the presentation. So far as transfer pricing is concerned, as we know under section 92C2 and the proviso, second proviso, there is a deviation that is merited now plus or minus 3% between transaction value and the ambient price is permissible. As opposed to that, in customs, there is no such range which is specified, plus or minus 3%, but it's largely left to the discretion of the appraiser or customs valuation officer to determine that despite the fact that there is a difference, whether the price variation is acceptable or not. So whereas transfer pricing is more formative in what is the tolerance range that could be seen as 3%, this part of the regulations, there is no such deviation that is set out for the custom authorities to agree or disagree with a taxpayer or for an importer for that matter. So far as deviation from ALP is concerned, there is no hierarchy of method that could be applied. You could choose any of the methods that are specified in section 92C1, and I'm sure we are all aware of what are the methods which are there. And of course, finally what matters is which is the most appropriate method that would be applicable to your international transactions. That's really the important part so far as transfer pricing is concerned. As far as customs is concerned, you need to follow sequential order of elimination of the valuation methods which are given. So we look at the methods as we go forward from here. So there's some differences in terms of how do you relate the method of looking into transactions. Under transfer pricing, we have 5 methods that are there. You could choose any of the methods which is most appropriate, whereas custom doesn't talk about it in that order. There is a sequential process of eliminating method as we go forward from there. So let's look at it. What are the methods that we would have to deal with as we go? So the first is, of course, even in transfer pricing, we have the CUP as the best method of the best choice that you could look at, comparable and controlled price. As compared to that, in the transfer pricing, in the customs regulations, you will find transaction value of identical or similar goods as a rule, which is the first choice of method to look at for the purpose of imports. Then we have resale price method, which is comparable to deductive value method under the customs regulations. Then we have a cost plus method, which is again comparable to the computed value method under the customs regulations. Profit split method, T&M don't find a reference in the customs valuation, so you can ignore them for the purpose of today's discussion. Profit split and T&M have no bearing on this particular subject. And finally, we have other method that is now being prescribed in the section which is coming the last couple of years. And as compared to that, there's a residual method also under the customs valuation rules. So these are the methods which are available, and as I mentioned to you, so as customs are concerned, you need to start with the transaction value as a starting point. If that method doesn't apply, then you have to go to the next method. Whereas under transfer pricing, you are free to choose any of the methods which are there on the statute, which being the most appropriate method. Now let's look at the procedure and compliances that are applicable. Of course, we all know transfer pricing is an annual compliance exercise. Whereas at the customs, it's an import-based, it's a transactional duty. So it is applicable at the time of import of goods per se. Documentation, again, I'm sure you would have digested a lot of information on this subject, is that the enterprise and transaction-wise contemporaneous documentation is a requirement that the taxpayer has to come up with. As far as customs are concerned, there is no requirement which is specified by the legislation for justifying the import price insofar as import from related parties is concerned. Again, under the transfer pricing regulations, the reference could be made by the officer to a TPO if it is necessary, and generally based on monetary thresholds as we understand. Whereas in terms of imports are concerned, there is a reference to the special valuation branch, SVB, as we all understand, for import consignment. So that's the reference that could be made for bringing the valuation authorities on the subject. Audit, of course, is prescribed in law in terms of transfer pricing. Lower threshold limit leads to an audit on year-to-year basis. Of course, that's what we all undergo every year. As opposed to that, customs, there is no audit, but of course it could be conducted on need basis. Validity of the order of the transfer pricing officer is only for 1 year as such, whereas SVB order, which is made out for a particular transaction or set of transactions, is valid for 3 years. Unless manner in which import transaction occurs changes materially, then that order is not applicable.
So whether in case of import from A, in all the cases matter will be referred to SVB?
Not necessarily. If the transaction prima facie does not meet with what is seen to be, if I may just go take you to the, if there is there is a relationship that is existing with the party which seems to have affected the price of imports, then the reference is made to this SVB. It's not necessarily that every import would go to SVB for that matter. Lastly, if I take you to the comparison of the penalties, of course, we are familiar with penalties under the transfer pricing regulation, which is, of course, fairly stringent, 100 to 300% on tax adjustment, 2 to 4% of the transaction value for non-maintenance of prescribed documentation, and finally, rupees 100,000 for non-furnishing of Form 3CV. These are spate of penalties that we have in transfer pricing. As opposed to that, customs also have similarly 100 to 300% custom duty for shortfall, that is the duty that is paid. Interest, of course, is there for non-payment of duty, which is also concomitant with the custom duty. But most importantly, in customs you'll find confiscation of goods of import. That's a huge penal provision over here, and also it could translate into punitive action on importer as well. So it could lead to imprisonment, which you don't find it in transfer pricing. So the non-compliance from a customs perspective, which may trigger penalty provisions, are far more harsh in customs regulations as opposed to transfer pricing. So that's the key difference in terms of penalty provisions. So let's quickly look at the valuation methods which are there in transfer pricing and customs as a comparison. So let's start with the first most important, and as we discussed in the earlier slide, is that the profit split and the TNM method are not of use for this particular subject. So we need to look at the comparison, which is the first one, which is CUP as well as transaction value of identical goods. We will find the reference to CUP under Rule 10B 1A, and as opposed to that, under the customs valuation rules 2007, the corresponding rule is Rule 4, which deals with transaction value of identical goods. Under both the methods, the prices charged for identical goods imported at about the same time as the goods being followed. That's a similarity that you will find. And at the same time, both the rules mandate that you can make adjustments to the value of the imports in terms of the quantitative factors, commercial level factors, and if there are any significant costs and charges included in goods being valued, even though the adjustments are permissible for transfer pricing as well as for customs valuation. However, there are some differences also at the same time that we might be mindful of. And the first is product comparability, which is far more stricter under transfer pricing regulations. Is that if the product is not comparable, you have to just drop and look at another set of comparables to look at. Whereas customs is more tolerant, so they've not only looked at the same product as the starting point, but they're also looking at identical or similar products. And these are both are defined terms in the customs valuation rules. Identical and similar goods. So they're extending the definition of what could be comparable from a strict product to two more criteria, that is identical and similar products. At the same time, if you look at it from the perspective is that how does a comparison entail under CUP method for the transfer pricing is that if there are a set of imports that have happened and there are more than one price paid for the same product, the arithmetical mean of prices is taken as a comparable if it's an uncontrolled import, uncontrolled comparable which is there. As opposed to that, under the customs regulation, if the threshold is not met with in terms of what is the value of import, then the lowest value of the transaction is to be looked at as per Rule 4.3. So it's more specific as opposed to an average that's been used in transfer pricing. So if you look at the next example on the screen, there is an import that XYZ has done of 10 kilo of raw materials from a foreign associate enterprise for a value of rupees 1,000 per kilo. And the details of comparable imports which are made at the same time are as follows. There is an import of 10 which is at 1,050, there is an import of 12, 830, 8, 905, and again 10 which is at 1,075. So the arithmetical mean is 965. So in this example, if you look at it from a transfer pricing perspective, assuming that these imports are comparable and they are comparable but uncontrolled, the officer will be happy to use 965 as a comparable, and there's a price difference of 35 rupees that you have in comparison to 1,000 that you paid. So that's the difference which is there in front of the transfer pricing officer. As far as the custom officer is concerned, he would settle at 1,050 in this particular transaction, with the lower of 1,050 and 1,075. So that's the key difference over here, is that both the authorities look at the same set of prices of imports in different ways. While one officer transfer pricing is looking at 965, the customs officer wants to look at 1,050 as a comparable price. So that's the difference between the two methods that's coming out very clearly over here, the arithmetic mean and the lowest value of transactions that you may find. So that's the starting point, and I think that's largely the biggest level of comparable to look at. But of course, the world is not perfect. You may not find comparable transactions which are uncontrolled. So we need to move on to the next method, which is the pricing in terms of retail price method and deductive value method. That's again a comparable between two regulations. So this retail price method is specified under Rule 10B, subclause 1 and again subclause B thereafter, whereas deductive value method is Rule 7 of Customs Valuation Rules 2007. So again, let's look at the similarity which are there, is that both of the methods take into account that start with the import price and discount it then after that with the margin that the importer has, the importing company or the SSE has taken into account, and also reduce the direct cost that you would have taken into account for the particular import, which brings you to the ELP price. Whereas transfer pricing and the resale price restricts itself to that. Under the deductive value method, even for example in the resale price method, it ignores anything to do with valuation, any processing charges that might have been added to the import. So if there is a step that has been taken into by the importer after the import has happened in terms of processing the goods, resale price fails over there. Whereas, so far as deductive value method is concerned, you would still want to consider this as an expense has been incurred, and would reduce that price to arrive at the arm's length price for the purpose of import. So there is some again difference that we notice between the retail price method and the deductive value method, and that's more, how would I say, the deductive value method is more refined to that extent, whereas resale price method is a pure trading import. It doesn't want to take into account any processing charges that's embedded inside transaction. A resale price method would not be applicable in a situation where a processing is also embedded inside a transaction. The next method, of course, is the cost plus method, which we are all very familiar with from a transfer pricing perspective. is that it's an addition of a margin or a markup to the cost of imports of value of materials and any other charges that has been paid as part of the import. And so you can add an amount of profit or general expenses to the cost plus cost to arrive at the cost plus margin. Identically to that, a computed value method also would take into account the same, which is again the computed value method is part of Rule 8 of the custom valuation. The only difficulty that you notice is practically this method is not very friendly to the user. Number one is that in case of imports where you want to use in transfer pricing regulation, the foreign party or the associate party as the AE, in that situation that could be the tested party, which is a foreign tested party, something which you are not very comfortable with. The reason therefore is again is that when we have to justify the markup, it's all the more challenging because we have to look at foreign databases to look at similar markup. Which itself is a challenging aspect. So in a sense, the cost plus method versus computed value method for the purpose of imports is not something we are very easy to use in terms of transfer pricing, as well as computed value method of course is, doesn't have requirement to compare it with foreign databases. So that's the differences in the two methods. Finally, the mandate of the other method is there under Rule 10 AB now, where you could use any other method for transfer pricing. And correspond to that, in the customs regulations, you have the residual method, which is again specified in Rule 9. And both of these methods are almost similar in principles. The general principles are same, using reasonable means. So the residual method of the customs law provides it where the method value of imported goods cannot be determined under the provisions of any of the specific methods which were set out before. Starting with the transitional value, thereafter the deductive value, and then again the computed value. You could go back to look at the residual method, and using reasonable means consistent with the principles and general provision of these rules, and on the basis of data available, you could justify your pricing of imports under the residual method. So that's other method as well as the residual method. We don't seem to be using other method as often in the transfer pricing study. And likewise, the residual method is also the method of last import. In terms of if other methods are not able to bring your price for the purpose of determining a customs levy, then you might want to use the residual method. So that's so far the methods are concerned. So the methods are already there in both the regulations, more or less identical in some ways. Some differences are there, not to speak of, but that's how the valuation is done. But the results come out very differently under both transfer pricing as well as customs valuation rules. Is that, as we saw in that example, is that same set of facts, the transfer pricing valuation results into a different price as opposed to customs. So that's what's the key takeaway for the purpose of our discussion today. Now let's come to the heart of the situation. What is that is bothering us, which is the issues and impact. So impact on customs should be considered while setting a transfer price or changing it prospectively. That's one of the key factors that one would need to be mindful as you determine your international transactions and imports from associated enterprises. Now we also understand that there are possibilities of retroactive upward adjustments of on account of transfer pricing. So we have, when we do a certification at the end of the year, we find that the price of imports need to be adjusted because of certain criteria. Then there is an upward adjustment that has been called for at the time of certifying the transactions. It doesn't go down well with the custom authorities. Is that what it means is that you suppress the value of imports or undervalue the imports at the time when you did that, and this may result into additional custom duty which you may be asked for to pay. So any retroactive upward movement of adjustment that you make, so put it effectively speaking, is that when you certify international transaction at the end of the year in Form 3CB, and if there's an upward adjustment that you are mandating for the client to make or the taxpayer to make, also expect that you could have a parallel, how would I say, nuisance coming from customs for short payment of custom duty. So that's an important aspect that we should be always looking at as we go. Likewise, if you're looking at retroactive downward adjustment to transfer prices, on the other hand, This may not be again acceptable to custom authorities in that is that if there is an excess custom duty paid, you cannot ask for a refund of that. So if